Hi, and welcome to this week's market presentation. Latest news. In the latest energy news, energy markets continued to face significant volatility with the evolving situation in the war between the US and Iran. Peace talks between the US and Iran gained momentum over the past week, with a peace agreement appearing to be in sight. President Trump added to the optimism with statements stating that the negotiations were in their, quote, final stage. The reported terms of the peace agreement between the US and Iran would include the reopening of the Strait of Hormuz, even with Iran charging a fee to transit, an end to the US blockade, the release of at least a portion of Iranian frozen assets abroad, as well as the transfer of the stockpile of highly enriched uranium to the US or a third country. Nonetheless, mixed signals followed the statements by President Trump and Iran, including threats by the US of renewed military action if a deal was not struck. The negotiations did leave key issues, especially the nuclear issues, as well as the existing sanctions regime, to be discussed at subsequent peace talks. Oil prices fell sharply midweek on hopes of a deal being reached, with Brent having dropped by roughly $10 a barrel before seeing some recovery at the end of last week. The geopolitical premium has been priced out to some degree before returning in clear signs that while a peace deal appears closer in sight, there is still no guarantees. Markets remain very volatile, caught between peace hopes and the existing tight supply situation, especially following statements by the IEA warning that global oil stocks could enter a, quote, red zone by July or August if transit through the Strait of Hormuz is not normalized. Over the last few weeks, global inventories are now being drawn at near record high levels, with an average rate of 2.5 to 3 million barrels per day. The US is leading the way with releases from its Strategic Petroleum Reserve, which saw a record decrease of nearly 18 million barrels over the past week. As transit through the Strait of Hormuz remains effectively blocked, the IEA is now actively discussing a potential second coordinated stock release if a peace is not reached shortly. The statements by the IEA highlight the severe physical tightness in the crude oil market in the US, and SPR releases are failing to prevent the major supply deficit stocks, with those global oil stocks completing at a record intensify as we move. The economic toll of the war is becoming more apparent, particularly in Europe, with weak PMI data for the month of April. The Eurozone composite PMI fell to 47.5, with the services sector down sharply to 47.6 over the past month. The US economy has remained more resilient, but nonetheless is facing significant pressure, especially when it comes to inflation. The latest data confirms some of the fears regarding demand destruction in Europe due to the high energy prices, and it is acting as a bearish headwind for oil, gas, and copper prices, given the prospect of decreases in industrial manufacturing sector demand. Adding to the concerns over the European economy are the economic underperformance that is weakening the euro against the dollar exchange, and overall continues to reinforce the concerns over a slowdown in the global economy due to the war. Weather. Regarding the latest weather forecast, temperatures across most of Europe are expected to rise significantly above seasonal averages, with temperatures over the next 4 to 6 days as high as 10 degrees higher than average in southern and western Europe. Precipitation is expected to remain limited over the next 4 to 6 days, although we're expecting now some increased precipitation at the beginning of next week. In terms of wind speeds are expected to decrease throughout most of this week before picking up again at the beginning of the following week. Crude oil and LPG. Moving towards crude oil and LNG and LPG markets, we see the decrease in crude oil prices week over week, although once again, we continue to see high levels of volatility. Overall prices have come down 4% for West Texas crude and just over 5% for Brent for the front month. Although again, prices remain elevated. And further along the forward curve, we see estimates for prices for the forward year remaining close to at $80 a barrel for both Brent and West Texas crude, highlighting that even if an end to the war comes shortly, we will see elevated oil prices through the remainder of the year and likely through much of 2027 as well, certainly compared to pre-war prices. Looking at U.S. crude oil and petroleum product stocks, we see the sharp decrease in those stocks over the last few weeks, pushing now near the lowest levels we saw during 2022 and 2023. Most impactful has been the decrease in crude oil in the Central Petroleum Reserve, which is now pushing towards the lowest levels we have seen in decades. Natural gas. Natural gas prices saw relatively minimal movement over the past week. Slight easing of the price level, especially for the third quarter of 2026, down just around 2.6%, with the front year seeing a decrease of 1.3%. Again, the decrease in natural gas prices very much driven by the increase in hope for a peace agreement between the US and Iran that will see transit gradually normalized through the Strait of Hormuz. Nonetheless, the current level of storages for natural gas in Europe raising certainly some concerns over the security of supply for the winter months. Storage inventories in Europe, while continuing to increase over the past week, are doing so at a slower pace than we've seen in previous years. As a result, we've seen the deficit versus last year's levels widen over the last couple of months. Total supply and demand saw decreases over the past week. On the supply side of things, we continue to see the impacts of lower LNG sendouts, while unexpected outages at Norway's gas infrastructure led to a further decrease in Norwegian gas flows to Europe. On the demand side of things, we're certainly seeing the impact of the weather on total demand, with the higher temperatures certainly leading to even further reduction in heating consumption, while at the same time, the heat wave that's expected to come across Europe over the next 7 to 10 days could lead to an increase in gas demand from the power sector, especially given the poor outlook for wind power generation. Injections, as we can see here, while continuing, are now over the past week near the bottom of the range over the last 13 years, notably below the past 13-year average and even last year's levels. The supply mix, as we can see here, continues to be hampered by maintenance across Norway's gas infrastructure, reducing flows to Europe, while LNG sendouts are now pushing below the past 5-year average, very much highlighting the tight supply situation for LNG and the growing price competition with Asian consumers, which, as we can see here, continues to be paying a noticeable premium versus European gas prices. Investment fund positions saw a slight increase in the level of long positions as market participants continue to digest the prospect of an end to the war and the risk that a continued block of transit to the Strait of Hormuz will lead to even tighter supply situations for Europe. Coal. Coal markets saw an uptick in the price level for the frontier for the API2 index, and looking at the 2028 pricing increases for the API4 index as well. Overall, for the coal price evolution, we definitely see the prospect of an end to the war in Iran, alleviating some of the geopolitical risk premium that could see a reduction in coal consumption from gas to coal switching in Europe and in Asia. But at the moment, the high prices continue to increase coal demand in Europe. Over in Asia, Chinese demand remains robust. On the other hand, we are seeing currently an improved supply outlook from Indonesia, although concerns over summer weather conditions due to the El Nino weather pattern could see additional disruptions to those supplies, tightening global supply outlook. EU and UK emission allowances. Moving towards carbon allowances, here we note limited movement over the past week, with prices remaining relatively stable. On the bullish side of things, the Polish parliament rejected the debate at the European level regarding the ETS market reform. While on the bearish side of things, we certainly see the weaker economic outlook for the Eurozone reducing demand expectations for the manufacturing and industrial sector, and also the front loading of the 40 million tons of allowances also easing some of the supply tightness we see currently. Emissions from the power sector remain slightly above last year's levels over the past week, in part due to the decrease in wind power generation. As we move to the summer, the prospect of above average temperatures and higher cooling demand adding some concerns over what summer power sector emissions will be. Investment fund positions remain relatively steady on both the European and UK side of things. On the European side, market certainly adjusting to the prospect of additional emissions from power sector, industrial sector, especially if we continue to see elevated gas prices. While on the other hand, the weaker macroeconomic outlook weighing on future demand. Electricity. Looking at electricity prices there, we see German power prices seeing relatively minimal movement over the past week. On the one hand, electricity prices certainly saw a slight decrease from the decrease in natural gas prices over the past week, although there's still elevated carbon prices keeping prices in check. Look at price evolution across other European markets, we see a similar evolution with more limited movement over the past week. Over in the Nordic region, particularly Norwegian power prices, seeing additional upward pressure from the lower hydro storage levels and the poor hydropower outlook. Looking at the European supply mix, we note an improved nuclear power generation output from France, with output now at the highest levels we've seen over the last 3 years, near the top of the past 5-year range. Nonetheless, renewable power generation saw a decrease over the past week on the back of poor wind power generation, which then led to slightly stronger demand for fossil fuel power generation. On the side of renewables, we see that sharp decrease in wind power generation, which was compensated by an uptick in solar power output, which continues to perform at a record high level this year. Fossil fuels saw additional support, particularly for gas and coal-fired power generation, both of which are seeing output levels above last year's levels. In terms of hydro reservoir levels, we see a worsening situation for the Nordics, with Norwegian hydro storage levels now at a deficit versus the past 10-year average. Over in southern and western Europe, there we see an improved picture when it comes to particularly the Iberian Peninsula and France, with still a deficit when we look at Italy and parts of the Baltics. Lastly, looking at the guarantees of origin price evolution, we note a slight decrease in the price level, likely as a result of some profit taken following the sharp increase in prices throughout the month of April. Overall, prices continue to be supported by the Nordic hydro deficits that we continue to see, as well as the expected increase in demand for guarantees of origin over the coming years. That covers this week's market presentation. Thank you for joining.